much. Well, good morning, everyone. Thank you again for taking the time, sharing a little bit of your time with us this morning. I do want to just say thank you to our gracious hosts here, the MCSC Women's Business Center and Patty Fox, in collaboration with the SBDC as well. It's always a privilege and honor to be with you guys. Again, my name is Cecy Toro. I am both proud and humbled to be the Business Development Manager here at Working Solutions. And today I want to talk a little bit about capital readiness and how to prepare for a business loan with CDFIs. So we're going to talk a little bit about what CDFIs are, right? What are they? What do they do? We'll talk about Working Solutions as a CDFI. We'll touch a little bit about having the mental readiness when you are approaching to become loan ready and apply for a business loan with a CDFI, the documentation readiness and the approval readiness as well. And we will have some time for Q&A. So I do encourage you, if you have questions as we're going through the presentation, please jot them down so that we can go through them together at the end. All right, so what are CDFIs? CDFI is an acronym that stands for Community Development Financial Institutions, and it's where the world of community development and the world of the financial industry meet. It's where they collide. CDFIs are private, mission-driven financial institutions which exist to fill the capital gaps in low and moderate income communities that have not been well served by traditional financial systems. And they do this by providing flexible financing options and technical assistance to individuals and communities. So they can provide a wide range of financial products, primarily debt capital, to finance a variety of sectors. So some CDFIs offer affordable housing, some are credit unions and community banks. Some are even nonprofit venture capitalists that offer funding for equity in businesses that are making significant social impact. But most CDFIs, most are small business lenders, and Working Solutions is one of them. So I just want to go over a couple things in this bar chart here, and this data is courtesy of the Opportunity Finance Network of OFN. And if we focus on just the small business and the micro enterprise, we're looking at 44% of the entire CDFI industry is currently servicing the small business community by way of small business loans and microloans. So microloans are usually under 50,000, okay, and small business loans usually around 100 to 150,000 or less, right? And so some CDFIs will specialize in only doing one type of lending, like those that specialize in affordable housing, for example, and others can do multiple. But different kinds of assets will require different kinds of underwriting, right? So the CDFIs that do work within the small business community and in lending, they work with businesses at all stages. So everything from pre-revenue startups and early stage businesses to mature existing businesses as well. And CDFIs often specialize in working with small business owners who have struggled to get capital elsewhere. So sometimes these are small businesses that are a little newer and maybe riskier in other ways for traditional financial institutions. But sometimes they can also be business owners who just haven't figured out the system yet, right? Those who might struggle to put together an application or don't understand how to get their documents ready or loan ready, so to speak. Or they might have a language barrier, or perhaps they have thinner credit histories, right? So because of this reason, intermediaries within the CDFI space, they'll often do a lot of advocacy work as well. Okay, so a little bit about Working Solutions CDFI. We are a mission-driven nonprofit organization accredited through the U.S. Department of Treasury to be a small business lender. And we pride ourselves on being the first to believe in small business. And our mission here is very simple. It's to get our capital into the communities where it's really needed the most. And I'm proud to say that last year alone, 97 cents on every dollar that we loaned went to either a woman-owned business, a low-income individual, or an entrepreneur of color. So Working Solutions has the legacy to deliver and is well positioned to address California's critical financial gap. We are strategically positioned to help service pre-revenue startups and early stage businesses, especially within our priority communities, but we do not exclude anyone. We, of course, service mature existing businesses as well. And we're committed to increasing the economic opportunity for the smallest of businesses. So these are the mom and pop shops, the in-home daycares, the food truck businesses, the hair and nail salons, right? The businesses that do not have many tools and resources available to them, particularly when they are starting out and are most vulnerable to predatory lending practices. These are the businesses that we are servicing and funding. We offer small dollar loan amounts and partner with these businesses to help them grow and scale their business with our business consulting program that we have on the back end of every approved loan with us. And on average, Working Solutions clients more than doubled their business revenue between their first and second loans with us. I love this slide. This is our all-time impact since inception in 2005. We have deployed a total amount of $61 million in total loans and grants into the community, 50,000 plus hours in technical assistance that we've offered, 3,200 businesses funded. And again, this is before we had gone statewide and when we were only servicing Northern California. So this is a pretty big number. A lot of those businesses are returning borrowers with us. And our average loan amount from microloans, so loans under 50,000, is around 26,000. And our average loan amount for our small business loans, which is over 50,000, is at around 83,000. And I do want to point out as well that we have just a fabulous 93% repayment rate on all of our loans, which is incredible considering that most of our loan portfolio are made up of startups and early stage businesses. And that just speaks to how well of a job our business consultants are doing at really partnering with the small business owner and helping them to grow and scale their business. Here on the right-hand side, the total deployment since inception, if you notice here, 60% of our deployed dollars was just in the last 5 years. And that is also huge considering that in the last 5 years, we had an entire pandemic, right? When small businesses were closing, when they were being significantly affected, we were able to deploy the most of our dollars into the community, not only being the first to believe in small business, but the first to respond to businesses that were in crisis. So here are our priority areas. Again, 50% of our entire loan portfolio is made up of startup businesses. And when we say startup, we mean either pre-launched startups or businesses that are still within their first 12 months of being in business operations. And then a whopping 80% of our entire loan portfolio are early stage businesses, meaning they are within their first 5 years of being in business. The majority diverse populations that we service here, 65% of our loan portfolio are low income entrepreneurs. Okay, not low to moderate, but low income entrepreneurs. 80% are people of color owned businesses or BIPOC entrepreneurs, and 60% are women entrepreneurs. Our product offering here is very simple. We offer capital by way of small business loans and microloans and small business grants when they're available through us or through our partners that we'll partner with those who do offer grants. So oftentimes city government grants, federal government, and private dollars from foundations to help support small businesses when they're available. And then paired with that capital is our consulting services. So we do offer pre-loan technical assistance in just getting loan ready, right? And then post-loan business consulting services, which I'll touch a little bit more on here in just a few minutes. Okay, so our loan product, right? So what type of funding does Working Solutions offer and how do we meet the needs of business owners? So again, small business loans, microloans, right, and grants. So our loans here range between $5,000 and $100,000. Anything that is between 5 and 10,000 is paid over a 3-year loan term. And anything that's 10,001 and above, all the way up to that $100,000 max, is paid over a 5-year loan term. We have a fixed interest rate of 11% clear across the board on all of our loans. It doesn't change, it doesn't vary, it's fixed, and it's not credit based. Okay, that's just what it is. We do have an application fee of $50, which helps to cover the credit check and the initial credit assessment of every person on the loan application. It's a one-time fee. We have a closing cost of 5% of the loan amount. Again, usually with other lenders, those closing fees are due at loan signing. But here at Working Solutions, we do offer the option of rolling that into the loan to avoid an out-of-pocket expense for the business owner. So the only out-of-pocket expense would be that $50 application fee. We do require a personal guarantee on all of our loans, and that is pretty standard in the CDFI space, right? It simply means that if the loan is approved, the business owner is personally responsible for the loan payment. We do not have a minimum FICO credit score requirement here at Working Solutions. I'm going to say that again. We do not have a minimum FICO credit score requirement. That means that when we check the credit, we're looking at the payment history, right? We're looking at what the monthly obligations are. We are not considering the FICO score in determining the loan. There is no minimum business revenue, right? Again, it can be a pre-revenue, pre-launched startup business, okay? There's no collateral requirement on our loans. We do not ask for real estate assets as collateral for the loan. We do not ask for vehicle assets. We do not ask for children. We do not ask for any collateral on our loans. We don't do that here. There's no prepayment penalty as well. So if the business owner wanted to pay off their loan sooner before the term is up, they certainly could. There's no penalty for doing so. And we do accept I-10 applicants as well. All right, so a little bit about our eligibility requirements here. So owners do have to be at least 18 years old or older. They do have to have at least 1 year of demonstrated experience in the industry that they are looking to start their business in. Okay, so somewhere in their background, they have to have at least 1 year of industry experience in the industry they're looking to start a business in. Owners should not have any past due accounts on their credit. Okay, so any active tax liens, civil judgments. These are things that no lender wants to see on a credit report, even those that don't have a minimum FICO credit score requirement, right? And no active or discharged bankruptcy within the last 12 months. The business operations do have to be within the state of California in order to qualify or to be eligible to apply with Working Solutions, and at least one owner must be a California resident, must live and reside here in the state of California. And our startup businesses do have to have a secondary source of income. Okay, so when the business is barely starting out and pre-revenue and there's no business taxes yet, the business owner has to show they have a way of covering their household expenses, etc., as they start and grow their business. We do have some industry restrictions. The excluded industries are very similar to those of the SBA. So we're not able to fund businesses that are cannabis related, anything involving gambling, anything that offers lending or banking services, passive real estate, meaning investments. So we are able to fund, for example, a realtor's office operational costs, like if they had a receptionist on payroll or they needed funds for equipment in their office, but we're not able to provide funds for them to go and flip a property, okay? Also, businesses that offer services of a prurient nature or anything involving the adult entertainment industry, we are not able to service. And although we are a nonprofit organization, we're not currently able to service other nonprofit 501c3 type structured businesses. And then we have our restricted industries, and those are the ones that require a second level review. So those would be our smoke shops, liquor stores, and anything involving the manufacturing, sales, servicing, or distribution of weapons and firearms. Okay, so a little bit about our consulting, our business consulting program here at Working Solutions. So beyond financing, We offer a business consulting program that helps businesses improve their money management and their marketing strategies. So we offer pre-loan technical assistance, meaning if we're servicing a pre-revenue startup, we do provide them with tools and resources to help them create a business plan and at least 2 years of financial projections if they do not have one yet. And if they require more personalized assistance, we connect them to free business advisory services through our partners, like the MCSC Women's Business Center, like the Small Business Development Center, right, where you guys get more of that personalized technical assistance. And then we offer our free post-loan business consulting services. And when we say free, we mean it. It is free for the full term of the loan, so up to the full 5 years. The business consulting is offered through one-on-one sessions with consulting staff that we have here at Working Solutions, and through a digital library of online self-paced tools that you could reference, at their own leisure. So covering great topics around money management, marketing. We also offer connections to specialized resources within specifically legal and accounting fields. So everything that a small business owner starting out really needs in order to help them grow and scale their business. Okay, so let's talk a little bit about mental readiness, right? Are you ready for a business loan? And another way to say this is, are you prepared for the possibility of being declined, right? Because that is a very real possibility, and we want our business owners and our applicants to be ready to have a good level of understanding, not only to identify your confidence level, right? But being prepared for what a decline means. And here at Working Solutions specifically, a decline is more of a discovery process where the applicant is able to understand, right, the reason for the decline. They can learn from the opportunity. And we do provide a recovery sort of roadmap with action steps that can be taken for them to reapply in about 6 months or so. So it is again, a way to look at the business through a new, fresh pair of eyes and to understand the lender's expectations. So a little bit about document readiness here. Lenders will usually ask for these 3 types of documents, right? So we have our financial documents, and some examples here are, of course, tax returns, pay stubs of any secondary sources of incomes, bank statements, right? Financial statements. The purpose of asking for these documents is to verify the income, right, or revenue of the business and the expenses of the business and of the household, right? It's to ensure that if and when we provide you with a loan, that we're keeping you in a healthy financial place, in a healthy debt to income ratio. Then there's the legal documents that are requested. And when we say legal documents, we're meaning the legal structure of the business. So depending on how the business is structured, that's going to determine which legal documents we ask for, right? So if it's structured as an LLC or as a corporation or as a sole proprietorship business or partnership, et cetera, that's going to determine what we ask for. And it's really just to verify the legal structure of the business. Are you legally able to perform your business services, right? And then there's the planning documents, and these are pertaining to our startup businesses here. We do ask for a business plan, right? That's essentially the blueprint for your business. The business plan, at least 2 years of financial projections. If you could have more than that, that's even better. But the minimum I would say is 2 years. And if you're already, of course, engaged in a commercial lease, we would ask for the lease agreement. And again, the purpose of asking for planning documents is to verify the feasibility, right, of the business. Okay, so do you know everything there is to know about your business? And we call these the 4 C's of lending, right? Cash flow, credit history, your commitment level, and your willingness to communicate. So, cash flow is you do have to show either the business profitability or, if the business is a startup, a secondary source of income, right? Your credit history, you need to keep your credit healthy, right? And be prepared to share any reasons for potential delinquencies or collections on the credit that maybe you might not have been aware of. Your commitment level, right? As a lender, we want to see what your commitment is, what your own commitment is to your business, right? So why would we provide this cash injection or this investment into your business if you haven't done it yourself, right? And so we look at things like sweat equity. What is the time that you've spent, right? So not just your money and resources and what you've personally self-invested into the business, but also the time that you've spent either in the business or preparing for the business, or your industry experience within that industry, right? So that all of that speaks to your commitment to your business. And then, of course, the communication piece, being willing to explain any ups and downs in the business financials. You want to provide timely clarifications if underwriters reach out with follow-up questions, being willing to have that communication. These are all really important. And I want to just kind of go off on a little bit of a branch here and add a fifth C that's not listed on the slide, and that speaks to character. And that is something that CDFI lending specifically will look at when you are coming back as a returning borrower. So let's say, for example, you were able to approach a CDFI for lending. You were given a $5 to $10,000 small microloan for your business. And a year later or 6 months later, you return asking for additional funding, right? If when you return, you're asking for additional funding for the same reason that you asked it for in the beginning, because you did not use those funds for what you said they would be used for, right? So let's say they gave you $10,000 and instead of you using it for your startup operational costs, you went and bought a car, for example. We're going to look at that, right? A CDFI lender is going to look at that the second time around. Even if you've had timely payments, you've made your payments on time, everything is good. We're going to look at that fifth C, that character piece, right? So all of these are important: cash flow, credit history, your commitment level, your willingness to communicate, your character as it pertains to the financing picture, right? And the important thing here to remember is just not to give up, okay? Sometimes I know it can feel like an overwhelming process, but the CDFI space, me and my colleagues and all of those that operate in this space, we are here to work with you and to help prepare you for financing. All right, so just a quick little success story here. This is Cherise Spence with Spence Family Childcare. She was a stay-at-home mom for over 20 years. And after her spouse retired, they realized that there was a lot of people in their community that were looking for childcare. And so the funds they were able to secure through Working Solutions allowed them to expand their curriculum and to invest in better technology. And eventually their goal is to open a full childcare center. This is out in San Diego, California. And here, Ferdinand Puente with Agape Management Financial Services. He said, I started this business to transition out of a lifelong corporate career and set myself and my wife up for retirement. I needed capital for training licenses and other startup fees. But after looking at banks, credit cards, and countless easy solutions with very high interest rates, I almost gave up. None of those were the right option for me. Working Solutions helped me throughout the process and even provided us with business coaching. All right, so very quickly, just a couple, we'll go through this fairly quickly. What to expect in the loan application process with Working Solutions. So there is a apply now or apply here button on our website. That is the loan inquiry form, okay? That is not the full application link. That is simply to determine eligibility to apply with us, because not everyone is eligible, right? If it might be an excluded industry. So that form determines eligibility, or if you schedule a call with myself or any one of my colleagues on the frontline process, we determine that eligibility over our phone call. And we then email the full application link to you or to the applicant, right? So this is a personalized link that's just for you, just for your business. It's not found on the website, okay? And then you submit the application. There is that $50 application fee that helps to cover the credit check, the initial credit assessment. You go through credit screening. That all happens fairly quickly within about a day or 2 days. And then you're sent a portal a secure link where you can upload your documents securely, right? So the documents that we're going to ask for. Now, the timing here in step 3 is determined by the applicant. Again, it's how loan ready are your documents? How quickly can you turn over those documents? And then you'll go into underwriting for application review and decision. If the loan is approved, and funds, it will fund directly into the business bank account. Okay, so very important. You want to ensure you're keeping your personal and business accounts separate. We have a total timeline here of 2 to 6 weeks. Again, a lot of that falls on the applicant and how quickly they can turn over their documents. But I have seen some loans go significantly quicker, sometimes even in just a week's time. So here are ways where you can stay connected to Working Solutions by way of our social media channels through Facebook, Instagram, LinkedIn. You can pull out your phones and scan the QR code there on the top right. That'll lead you to our website, workingsolutions.org. We do have our main Working Solutions info email there, and my email as well, cecy@workingsolutions.org. Our main line and my direct line. I'm always here and happy to help if you have any questions. I'd love to support you on your entrepreneurial journey and just be an added tool and resource for you. And so with that, I want to thank MCSC Women's Business Center again, Patty Fox for the invitation and inviting me to be here with all of you this morning. Again, my name is Cecy Toro. And I am the Business Development Manager here at Working Solutions CDFI, where we pride ourselves on being the first to believe in small business. And with that, I do want to open the floor for any Q&A. And I'm going to leave my screen up. So I'm not sure if there's any questions in the chat, but if somebody can just read them out to me, that'd be great.
Okay, hi, Cecy.
Hi.
I'll ask you a question. On the loans, do they go over the last 2 years, or will they go over the life of the business?
Is this for a existing business that has been around over 2 years?
Yeah, 13 years.
Okay, so depending on the loan amount, okay, so if you're asking for a micro loan that's under 50,000, if it's between 10,001 and 50,000, they'll only ask for the last most recent year of tax returns, just 1 year. And then anything 50,001 and above to the max, we would ask for the last 2 years.
Oh, okay, thank you.
Yeah. And if it's a startup business, we'll ask for your personal tax returns. Well, I mean, we still ask for personal for existing as well, but in lieu of the business tax returns, we're going to ask for that business plan and those financial projections.
Okay,
Thank you for the question. Great question.
thank you.
It looks like we have one in the chat as well.
Thank you. Okay, so Tia, is it possible to get this type of loan in addition to other loans, since I'd need more than 100K for my startup? Okay, Tia, that is a great question. And I'm going to say it depends on the lender, right? So if it's a CDFI lender and it requires a personal guarantee and the business will require a UCC lien, most lenders want to have first position, okay? And a UCC lien means it's kind of like if you're familiar with home mortgages or loans, when you get a home loan to purchase a house, you can't sell your house without that lender being paid off, right? So that's what a UCC lien serves as for a business loan. And most lenders want to have first position, okay? They want to ensure that if you were to sell your business 2 years from now, that the loan is going to get paid off. It also depends on your debt to income ratio. Are you including with your startup financial projections, right? Taking all of that into consideration, are you able to have the leeway in the income and revenue to cover this, let's say, $100,000 loan payment with Working Solutions, plus whatever additional funds you might need from another lender, right? So it's for us, when we're looking to qualify an applicant, the biggest question we have throughout the entire loan life cycle is, are we putting this person in a detrimental position if and when we provide them with this loan, right? Are they going to be in an overwhelming position if, if I quickly calculate $100,000 payment over a 5-year loan term at the 11% interest rate, that monthly payment is around $2,175, right? Just for the 100K. And that's a term loan, that's a monthly payment, that's not going to change. But, the other lending options that you might be looking at might have a variable interest rate, right? It might not be a 5-year loan term. It might be something, that's a little more aggressive. So again, depending on what you're looking at, and Tia, I'd love for you to get in contact with me afterwards because I do have partners in the space that also help to service pre-revenue startups for larger working capital than the 100K that we offer. So I do know of other CDFIs that can go higher, even when you're a startup. Okay. You're welcome.
Awesome. Thank you so much, Cecy. That was so comprehensive, and we really appreciate you taking the time to join us. Everyone, as you can see, Cecy's included her contact info. Feel free to follow up if you have any more questions. All right, and with that, we will move on to Israel Lara Jr. from the Small Business Administration Fresno office. All right, Israel, do we have you here?
Yes, good morning. How are you?
Awesome, wonderful. All right, I'll hand things over to you.
Give me a couple of seconds to get my screen.
Take your time.
Can everybody see my screen? Did it choose the right screen, hopefully?
We've got two screens. I think the presentation's on the left, and then we have a web browser on the right.
Okay, perfect. So I wanted to start with the web browser. If everybody can see that. This is our website, Small Business Administration. Again, thank you again for allowing me to speak. I'm Israel Lara from the Small Business Administration here at the Fresno District Office. And if you're on your computer or your phone, I would like you to go to sba.gov. And then click on funding programs. And I just wanted you to be familiar with our website with the programs, where 7As are, 504, microloans, lender match, and then our COVID-19 relief options. And this provides you some additional resources that we'll be going over today. And then I also wanted to go over, it also provides you some links on how to plan your business, launch your business, manage your business, and grow your business. And then it also provides you some additional assistance on free business counseling that we offer, SBA guaranteed business loans, and then we'll also go over some lender match website. If you go back to funding programs, and the reason I wanted to show you the website before I go into my PowerPoint is I wanted you to feel comfortable navigating our website. Sometimes it's difficult to look for resources on our website. And if you're on our website, if you're able to go to sba.gov, you can also go to lender match. And then here you can actually apply for a loan. And it will tell you how it works. You'll describe your needs, get matched in 2 days, talk to a lender, and then apply for the loan. But before you do this, we want to make sure that your lender ready. And before you start that process, we have a couple of suggestions on the website. Make sure you have a business plan. The Women's Center, it does a great job in assisting you in giving you examples of a business plan. They won't write it for you, but they'll at least guide you in how to write a business plan. It's very important that you have the amount and the use of funds so that you're prepared to answer any questions to the lender on specifically what how much you're going to need and how you're going to be using those funds. Your credit history. Some lenders are not so heavy on the credit, but some are depending on the type of loan. So you want to be familiar with your credit history. So before you contact a lender, you really want to go to your credit, either Experian or TransUnion, and check your credit report. Make sure you're familiar with it. If there's anything that that you see that needs to be updated or corrected, always dispute, dispute, dispute. And then your financial projections are very important. And then your collateral. Some loans will require you to have collateral, some of them won't. So you want to be prepared to identify what collateral you're willing to engage with. The financial projections, I'm going to go back a little bit. You want to make sure if it's a startup, you have 3 years. If you're already in business, you're going to have actuals, whether you're using QuickBooks, and that's going to be very important that you have an understanding. Make sure a lot of small businesses in the first, second, or 3 year will show a loss. You don't want to show a loss every year because that will depend on the loan structure or if you get approved. So you want to make sure that when you are doing loans that they're going to be able to pay back, and then you want to have good financial projections and then good financials, whether you're using QuickBooks or a CPA that does your financials. Now, industry experience is very important. It's key on developing a good resume and then being the expert in the industry. Before you even talk to a lender, one of the mistakes when I was a lender, people would come to me and say, I have no idea how to run my business. I need money. Don't ever go to a lender and say, I don't know how to run my business and I need money, because the first thing is they're going to get red flagged. And so you don't want to get red flagged. You want to become the expert. You are the expert, whether you're selling an ice cream or you're doing a pizza parlor or a taco mobile vendor or providing services. Whatever you're going to be an expert in, you got to be an expert. Be confident in your ability and the knowledge. Do your research, research, research. Before you go to a lender, please make sure that you are able to be the expert in that industry. Have a resume. Be ready to answer questions about your industry. And so you want to be prepared to answer anything about what your business is, why you're trying to start the business, any projections, what the research you've seen in that particular field, and then you want to be the expert, and then be able to talk and articulate that what type of industry you're going to be going to, and that's going to be very important to be knowledgeable in the industry that you're going to be trying to get a loan for, and that's going to be very important. So I just wanted to let you know about this website, and then there's also a link here for assistance for those who need assistance. You can look up the Women's Business Center, and you're on the call with one of our resource partners. But we also have the Small Business Development Center, SCORE, Veterans Business Center, and they all provide free technical assistance throughout the nation. So no matter if you're in California or in Texas, we do provide national technical assistance to all businesses that qualify. I also wanted to share for those who are in the state of California, sometimes we forget that there are resources. This is calosba.ca.gov. If you are on your phone, you want to type in that on your browser. That's calosba.ca.gov. And they also provide some resources through your state. Here they provide grants and financing opportunities. This is a great website for you to go to learn about what your state provides you as a small business. I work for Small Business Administration. We're a federal agency, but I always encourage our small business owners to look for what their state is offering for small businesses. And if I click on here, it will take me to funding programs that they have active in your state. And then this gets updated every week, every month, every year. And so you want to look and see what other state financing are available. Here's the type of industries. Here are the federal loans, small business capital. This is going to be the Small Business Administration. They have our website and our links to get additional information on the different programs and funding. They also do provide grants. As you see, there are no active grants available. But if you click on close, these are all the grants that they had for small businesses in the past. And so I encourage you to look at this on a regular basis. This does change. And so you want to be familiar with your state programs. Again, this is through calosba.ca.gov, and then they provide some additional information. So I would be familiar with this website. It provides a lot of key information for small businesses. Before I go on to the PowerPoint presentation, are there any questions on the websites I presented at this time? Don't tell me everybody is shy. Nobody has any questions, or I did a very good job in presenting these two websites. And I don't believe I did a very good job. So there's got to be one question out there. Nothing about your state resources, nothing about the SBA resources website. So I also wanted to introduce our National Resource Guide. This provides all the information that in a booklet for small businesses. You can go to www.sba document/support National Resource Guide in English. And this will give you an overview of all the services that we have. And matter of fact, I think I can probably put this in the chat, see if that works. Yes. So I'm putting these, there's one in Spanish as well. So I'm going to be putting these in the chat for you so you can click and go directly to those. And then I'm also going to do this one just in case there's any future grants. And that way, those who want to research on your own on any of the California programs, you have all of those for you. So now you have all our websites that are important. There's also, like I said, the local assistance. We do have some new programs, some new initiatives. If we do have any manufacturers on the call, there are some special financing for manufacturing, and you'll find them under priorities. If you do want to learn a little bit more about manufacturing, or you want to get into manufacturing, please give me a call. My information is on the chat, and we can talk offline a little bit more about the incentives for manufacturing. There are going to be some new initiatives and loan products available next year, specifically for manufacturers, for those who are starting or going to go into manufacturing. And so this is going to be exciting to see what's going to be available. USDA is also going to be providing some grant funding for manufacturing on specific industries. I'm not an expert in USDA, but I would definitely go to their website, USDA, and find out what resources they have on grants and funding for those who want to get into manufacturing. And on specific industries, they are going to have some initiatives to assist you, and those will be rolled out either in the next couple of months or the first part of 2026. So you want to be looking out for any of those opportunities.
Hi, Israel. It looks like we did get 2 questions in the chat.
Yes.
One of them is, how practical is it to get business loans from more than one source or lender?
So that's a good question. I used to be a loan officer during COVID. And one of the issues that we're seeing now is if you have a PPP loan that's outstanding, or an economic disaster loan that you're actively paying off or you're not, you really want to make sure that you're current with any SBA loan in order to qualify for a secondary loan. One of the things I see when we do start reviewing the application process, the lender is not but for some reason, lenders are not aware that they have an economic disaster loan or a PPP loan that's outstanding, and then that will stop the process. You'll have to update and bring those current in order to move on to a second application. We do sometimes, I think Cecy talked about UCC lien. Sometimes we will move ourselves from the first to a second if you're going to refinance or grow the business, but those are on a case-to-case base. That's rare. I've seen that happen, especially with economic and disaster loans. They will move, SBA will move on as a secondary in order for you to get a loan if you're going to expand or grow the business. But you really want to talk to your lender. If you're already currently in business, I would definitely sit down, talk to your lender. There are SBA lenders. SBA does not do loans directly. A lot of our lenders are either through micro lending, Wells Fargo, BMO, Bank of America, Chase. Those are our preferred lenders that are certified through SBA. The Women's Center can also help you navigate that and look for additional lenders that can help you. But I would caution you to make sure that you're not over creating more debt that you can carry, because that is going to harm the business in the long run. And so you want to have your documentation, making sure that any information that you're going to need, that you are prepared to answer those questions with the lender. It's not, I would say yes, there is a possibility of getting one or more sources to get a loan, but those are very special circumstances, and it just depends on the business structure and then the ability to pay back the loan.
We had another question about veterans business resources.
So we do have veterans resources. If you go under federal contracting, we have veteran contracting assistance programs that are available. Hopefully everybody can still see our screens. My screen, you can go to the SBA.gov, go under veteran contracting assistance programs. And then we also, under our local assistance, if you go to Veterans Business Outreach, if you are a veteran on the call, I would encourage you to contact the Veterans Business Outreach Center, because they, each of the agencies, the Women's Center, the Veterans Small Business Development Center, they all have special financing or programs or projects specifically for their groups, whether it's the Women's Center or the Veterans. And you really want to learn what is being offered for veterans, what special programs, what initiatives, whether it's federal, state, because most of the partners that we work with also work with state partners, and they have more insight on what your local state might provide for specific veterans, women's, or small businesses. And there are certifications if you go into federal contracting for small businesses. If you want to be certified as a small disadvantaged business, women-owned small business, federal contracting, all of these certifications, you can get assistance through the Women's Center, and they can help you get certified under any of these programs. So that is a great question, and I would encourage you to reach out to the Veterans Business Outreach Center or talk to the Women's Business Center to get you in contact with one of our V box centers. Any other questions?
I do see 3 more in the chat above your last comment. I don't know how we are on time, but there they are right there in the chat.
Yeah, I think we have us going to 10, but I think we can run like 5 minutes over. So I think 5 more minutes should be fine.
Okay, is the application process the same for loans versus grants? Now, I am a grant writer many years ago, and applying for a loan and applying for a grant are 2 different applications. Grants are, I'm not going to say they're more difficult, but they're not easy. You really need to have the expertise and have good writing skills, be able to articulate and put on paper how you're going to use the funds. And then in the application for a grant, it's going to specifically tell you what they're looking for. So you're going to have to do a lot of research. You're going to have to be the expert and then follow the instructions in the grant application. That is so important to follow the instructions and then answer the questions based on the questions they're answering. Do not um, alleviate from that. And then they're also going to ask for very strong financial. They're also going to probably ask for audit reports from the business. And most of the grants are going to be funded to businesses that are already in existence. They have a track record that can manage the funds, execute the funds, and then at the end, they will be auditing you and requiring updates and reports on how you spent the funding. So grants are very um, policy driven, meaning you can't go to Hawaii, you can't buy a car, you can't buy a home with that money. If it says it's only for marketing, then you can only use it for marketing, because at the end of the year, they're going to audit you. And if you went to Hawaii, you're going to have to pay back all that money. And so you don't want to end up in a situation where you're going to have to pay back the grant because you used it to go buy a car or a house or pay for a student's college fund. That's not what that grant money is. It's going to tell you specifically how to use it, how to expend it, how to report it and track it. So it's a little bit time consuming, but a loan is the same thing. The only thing is the loan you have to pay back. You can't get a SBA loan and go to Hawaii. I think Cecy did a good job in explaining that if you do get a loan for business, it's got to be used for business purposes only, whether it's payroll, whether it's to buy equipment, to expand, hire employees, do marketing. Those expenditures have to be tied in to the business loan. It can only be used for business expenditures. And so you want to make sure that when you do a loan or a grant, that is specifically being used for the purpose that you apply for. Does child support affect getting small business loans? Now, if you owe money to the federal government or to a state agency, it might affect your loan approval, but that's on a case to case. That's something that you'll have to talk to your lender, your loan officer, explain your situation. If you're on the list, sometimes the counties or states or federal government, depending on who's holding that child support hold, sometimes they're not as fast as reporting and might not show up, and sometimes they might show up. So it just depends on who's reporting you and how that's going to affect your loan. But I would be honest with the loan officer, make sure you disclose it. If you do have a payment plan, let him or her know that you are making payments and that you're not owing any money to the federal government, whether it's child support or to the state. Next question, if you child support, I think Cecy already did some of the explaining on that too. Thank you, Cecy. Any other questions? If there's no more time, we don't have to go through the PowerPoint presentation. I think going through the two websites, going to providing some of the links, hopefully that's more beneficial. I do want to, before we do leave, now, if you want to learn more about 7A, 504, microloans, lender match, you can click on each of these. And then what I was going to present in my presentation was really the information that you can get directly from the website. This talks a little bit more about what 7A loans are, what they can be used for, if you're eligible, how do I apply, and here's a link for lender match. How do I pay back the 7 loan, existing borrowers, working capital, get help. And again, my information is on the chat. So if you have any questions on any specific loans, you can always send me an email. This is our 504. It also tells you what a 504 program is. Are you eligible? How to use the 504 loan, and then what do I need to apply? And you always want to talk to the lender and get a checklist. Most of our micro lenders, our banks will give you a checklist of what you're going to need, what documents, compile those. Before you even apply, I would reach out to the lender and say, can you give me the loan packet so you can be familiar with it? They'll either email it to you or give you a hard copy and then ask for a checklist. Take that loan application, that checklist, to the Women's Center or to one of the resource partners, and then they will walk you through the process, and then they will make sure that you have all the documents before you start applying, making sure you understand the application process. Do your homework, do the research, introduce yourself to the lenders, ask questions, practice before you go to the bank, structure some questions. If you have a colleague or even the Women's Center, I would do some rehearsals before you go to a lender, making sure that the questions you're going to ask are going to be relevant and get you to the crossing line of getting approved. Again, I cannot point out again, do not ask the lender how to run your business. That's a red flag. If you go to the lender and the first thing you say, I need help, I don't know how to run my business, I need money, you're not going to get a loan, because the lender is not there to help. The Women's Center is there to help you manage and grow your business, making sure that you're going in the right track. The lender is there just to make sure that you're qualified to get approved for the loan. And a lot of times small business owners make the mistake by going to the lender thinking that they're going to be the consultant to help them sustain and grow their business. And that's not really what a lender does. That's what the Women's Business Center does. So before you ever go to a lender, make sure you attend some of the workshops the Women's Center, SBDC, SCORE, the Veteran Center provides on making sure you're lender ready before you meet one of the loan officers. And I'll conclude there and send it back to the Women's Center if there's any other questions.
Thank you so much, Israel. We really appreciate you walking us through the website. I know it can be a lot to navigate, so I really appreciate the practical walkthrough. And as mentioned, Israel's information is in the chat if you need to follow up with questions. With that, we will hand it over to Brooks Wise, who is the Executive Vice President of Pacific Premier Bank.
Good morning, everybody. Trying to get my picture here. There I am. Oh, I'm blurry. My camera.
And
I
can
was there.
everyone see my screen? I've got your slides up, Brooks.
Let me change my setting and see if that helps. There we go. Good morning, everybody. I have a special place in my heart for Mission Community Service Center as a former executive of Mission Community Bank. I was president of Mission Community Bank, and our CEO, Anita Robinson, this was her idea many years ago, and glad to see that it's still thriving. Michael Chen from our bank actually participates on the board, and so I'm really pleased to be here and joining you today. I'm going to follow up on some of the things that Israel talked about, more specifically to the state programs. We too are a SBA approved lender, so we can also help with SBA, but I thought Israel took you through some great exploratory of the website, because there's a lot of information there for you to digest and help you with your business. My focus is on two of the state programs. If we could go to the next slide. Sorry, next one. One more. Thanks for driving. CalCap is a state program. It stands for California Capital Access. This is a little different program from how it is funded. This is not a guarantee program. They actually, the borrower and the lender both pay a fee that goes into a loan loss reserve. They have a maximum loan size of $5 million. And while the maximum interest rate is 18%, most loans are either through a fixed rate or something tied to prime plus 1, prime plus 2. Prime is currently 7.5%, but maybe going down in the near future, making the cost of borrowing a little less. All of these programs, whether it's SBA or CalCap or one I'm going to talk about in a moment through Cal Coastal Finance, are really credit enhancements because many of you are just getting started in your business. You may not have built up the net worth within the company or the assets within the company. And so these programs help to offset some of those credit weaknesses through either the guarantee of the SBA or, in this case, it's a loan loss reserve. There's no maximum for annual revenues. It's really defined by the same terms as SBA as to what a small business is, with a maximum number of employees up to 500. Next slide. Loan proceeds can be used for a variety of purposes, from startup costs to working capital, franchise fees, equipment inventory. It's very flexible on the use of proceeds. It talks about bridge loans. One of the SBA products that's available is called the SBA 504. It's primarily used for real estate and equipment purchases. That 504 program, the bank does a 50% first trust deed, and the SBA does a up to 40% second trust deed that's subordinated to the bank. So you get access to capital with a little less down payment requirement. Well, CalCap can, when doing so, the bank will originate the first and a bridge loan until the bond debenture comes in and pays off the bridge loan. And sometimes that bridge loan needs a credit enhancement. So CalCap is available for that, which is also a bit unique. The businesses must be have its primary economic effect in California, and 51% of the revenues are generated from California, or 51% of the jobs to be eligible for the CalCap program. Again, this is a little different in it's not a guarantee. It is a loan loss reserve program. So I'll give you an example. The lender can charge anywhere from 2 to 4% fee to the client. The client would pay anywhere from 2 to 4%, but then the lender also kicks in 2 to 4%. That goes to a loan loss pool. So anywhere from 4 to 8% would be allocated towards a loan loss provision. And if something goes sideways and the loan doesn't pay off, the lender would go to the state to tap into that reserve to help recover some or all of the lending proceeds. The borrower, if they bring the loan all the way to full term and pay it off in full, they do not get that money back. That goes and stays in the program. So this loan loss pool gets built up and can absorb, and much like a bank, we have to set aside loan loss provisions for our credit functions. So it's a little different program, and that fee is non-refundable, but helps you gain access to specific loans to help support your company. If we can move to the next one. Ineligible use. You can see the list here: bars and liquor store, firearms, gambling, of course, cannabis clubs and things of that nature are not eligible, but there is a lot of flexibility with the program. Next one. Another program is offered in the state through Cal Coastal Finance. And they have a couple of different loan programs, much like the SBA 7A. These have a loan guarantee that is issued to the lender in support of a credit enhancement. They do also have some direct loans on a smaller scale that I'll share with you as well. Some micro loans. The maximum loan amount is $5 million. Can be used for inventory, accounts receivable, equipment. They also will help with rural agriculture loans, and of course, working capital. Borrowers must have a commitment from a lender to participate. So this is lender driven. We're a member of Cal Coastal, and have a representative on their loan committee. And there's other programs like California Coastal within the state. Another one that's really strong in Santa Barbara is Women's Economic Venture. WEAVE is its short. That's another access. They make direct loans as well. There's sometimes loan pools funded by your local city or county. But I'm going to focus on California Coastal for this presentation. The maximum on a line of credit is 1 year. Term loans is 7. Interest rate is based on market rates, typically tied to prime plus 1, prime plus 2, and is variable. And as prime goes up or down, so do the loan rates. And they may require additional collateral beyond the business, including personal assets. There's a 2.5% loan guarantee and a $250 documentation fee assessed by California Coastal above whatever the bank may be charging for a loan fee or documentation fee. Now, this is a guarantee program. It goes up to 80%. So if you want to get $1 million line, they would guarantee up to 800,000 of it. We, as lenders, work closely with the representatives from California Coastal. We provide them financial packages with your permission, and work jointly together to deliver the guarantee. Next slide, please. This one is their microloan program. Again, it's loan ranges between 5 and 50,000, mostly inventory, machinery, and leasehold improvements. It can be used in some real property. It's a fixed rate at 9.25% for the life of the loan, and there's a 3.25% loan fee. This is very good for startups, and this is a direct loan program through California Coastal and not through a participating lender. Next one. And so we have, Goldilocks and the Three Bears. They have the right size loans for whether it's the micro loan or the fully guaranteed 80% up to 5 million. They also have a startup facility with a maximum of 350. And this one has an extended term with loan maturities that are 25 years for real estate and up to 10 years for equipment. Market rates are negotiated by the lender. Again, they're typically tied to prime. There can be fixed rates available. And again, it's machinery, accounts receivable, inventory, and real property. And fees are based on the maturity and dollar amount of the guarantee. That's Cal Coastal and CalCap. Before I go into the next section, which is a little different than capital access, something I really want to put on your radar. Are there any questions about the two organizations that I covered?
I've got a question on what small businesses should have prepared when getting ready for these loans. Like, how do they qualify?
That's a great question. I thought Israel gave you some resources that the Women's Business Center is a resource. The SBDCs are a resource. There's also an organization that was on that list called SCORE. I know in working with the CIE, a lot of the companies that present at AngelCon are putting together a deck that talk about market opportunity and leveraging their net operating income and more value matrices. Lenders really use the 5 C's of credit, and I won't go, that could be a whole nother presentation one day. But the key ones are cash flow and collateral. And that's where some of these guarantee programs come in. There may be a weakness in the collateral side, and the guarantee will help shore that up. The key from a bank perspective is really the projections. And that's where I think business owners I have seen struggle a little bit. Organizations like the Women's Business Center, the SBDC, and SCORE have volunteers that will help you with those projections. Really, those projections are to demonstrate, how you're going to generate revenue, what your expenses going to be against those revenue, and how you're going to generate profitability over a 3 to 5 year period. SBA 7A and these programs will all work with projections, especially in the startup space. But it requires a little math. And as a banker, believe it or not, I went to Cal Poly. I have a biology degree. Not accounting, not finance, but a biology degree. But I would argue physics and organic chem are harder than accounting. But those experts within SCORE are retired executives, and they provide a really valuable service, as do the other agencies, in helping you put together those projections. I really like to go through that with a customer or with a small business owner. Okay, what's your idea? How much does it cost to, let's just call them widgets. You're selling widgets. How much does it cost to make that widget, or how much does it cost you to provide the services of that widget? And then how much are you going to mark it up from a profitability standpoint so that you get your gross margin? What other expenses do you have? Employees, et cetera, payroll, insurance, and what's your bottom line number going to be from a profitability standpoint? That's the simple math, but obviously it's a lot more detailed and varies depending whether you're a service company, manufacturer, etc. Cash flow is really what drives the repayment source. And so that's where, again, getting some outside volunteer support on putting together that budget is important. They can also kind of test you and say, well, if you price it at X, you're not going to have enough to repay the debt. Can you price it at Y? And those are the kinds of things I like to do with small businesses, is really kind of test not just the product and its marketability, but its profitability, because ultimately that's what repays the loan.
Thank you so much. Really helpful.
Any other questions? Oh, I do want to answer a question that was asked of Israel. Can you have more than one lender? That, I will say, depends on collateral. in business lending, we take what's called a UCC filing, Uniform Commercial Code filing. You can be limited to the number of lenders because they all want priority on that UCC file. Now, you could, though, have maybe vehicles that are entitled through DMV. That would be a separate collateral perfection that you may be able to get a different loan for some of the equipment financing. And then real estate has a deed of trust. So it really, obviously the cash flow has to support all those, but the collateral may allow you to work with different lenders. But it really is limited. And most lenders, they want to be the sole lender and not have split borrowing. But it can be done. I really want to bring this to your attention as small business owners. This is a little off track from capital access, but I just am so passionate about getting this information out. Fraud is just rampant right now, and they're targeting small businesses. When you file your fictitious name statement or your entity documentation, that's public record, and suddenly you will be on more people's radar than you thought. There may be bankers and SBA lenders reaching out to you, but there's also a lot of fraud going on. These last, I'll say 30 days has just been excessive. And so I want to put this on your radar because you're all going to need operating accounts to run your business. And treasury management platforms, or sometimes they call it cash management platforms, help provide some fraud deterrence. And there's a list of things here because what's going on now with cybersecurity is I know you probably all received maybe that UPS or FedEx email, and how do they know that you just ordered something off of Amazon? Or in my case, as a football fan, I had to get some new NFL gear for the season. How do they know that? But they do, and they send you this fake email, and then you click on it, and now they're off to the races. On the business side, it's even more sophisticated than that. Some of the fraud deterrence we have is something called positive pay. So a lot of information that fraudsters need are right there on your check. There's two key pieces of information that are on your check: a routing number and your account number. And once they have that information, they can clone your check. A lot of small businesses still use checks rather than electronic payments, and so they're a little more vulnerable. Most consumers are using online bill pay and things, and writing fewer checks, but on the business, or they're using debit cards, or they're using credit cards. On the business side, they're still using check stock. Positive pay, you upload your check register on a daily basis to the bank, so they know what you issued. But every morning you get a report of what's being presented, and then you have control over the pay and return decision, because it could be actually a fraudulent check. There's several other things. The most important thing I would focus on as a small business owner, you're small but mighty, but creating a dual control environment. In some cases, you're the only employee, so that gets tough. But if you have a few employees, you can create dual controls so that no one person can authorize and complete certain higher risk transactions, like ACH transactions or wires. These are a few of the things that you can do, but let's go to the next slide with things that are more within your control. Network security, do you have an IT consultant? That's really important these days to make sure your network is secure. Passwords. We as banks will not call you and ask you for your password. We already have it. The fraudsters are now spoofing clients, purporting to be the bank, and they're even spoofing with phone numbers that pop up that would say they're the bank, but they're not. They're fraudsters trying to get your information, your passwords, your codes, so they can access your online banking and move money. Do security updates, user training and education, and limit your user access. There's lots of key controls. There's bad actors that are identity thieves, internet stalkers, phishing scammers, and it is they don't come in and rob the bank at gunpoint anymore. That's a far bigger crime, armed robbery. They are using the internet to do social engineering, and one of your employees and underlings could give up a password and then you're compromised. And the next slide talks about another piece, which is your email security. A lot of the bad actors are fooling employees by intercepting one of your clients' emails and then acting as if they were your vendor or your client, but they're not. They've compromised the account, and then they start making requests to have your payment go to, let's say you have an ACH to a particular vendor. They then say, "Oh, we changed our accounts." So and then you go in and change it in your ACH system, your bill pay system, and now the item, the ACH goes to the bad actor and not to your vendor. So lots of protocols to consider. I really want to put this on your radar because you're just getting started in business, and you'd be surprised how much vulnerability there is as a result of these really bad actors who are very good at fooling people. Again, you don't want to open things and click on things. Take a strong look at the email address from the sender. There's usually just some subtle changes. Maybe instead of .com, it has a different three-letter sequence, or it looks like it's Amazon or UPS, but there's a spelling error within there. It's really subtle. It's really
We
tricky.
appreciate you coming, Brooks. And we'll hand things over to David Benham, who is an angel and venture investor. So thank you for being here. And I'll hand things over to you.
Thank you. Can you hear me okay?
Yes.
And hopefully you see my slides okay. Okay, so I'm here to talk about venture capital, which is really kind of a different animal, if you will, from generally getting capital from banks or similar institutions. And I want to try to do my best to paint, if you will, the picture of why it's different and in what ways, particularly from a lack of patience point of view, why that is, and see that those are ways in which you can kind of tell where your business is a fit for the venture capital community. I myself, David Benham, am a Cal Poly alumni from decades and decades ago, and just about 2.5 years ago, moved back to San Luis Obispo. And so while Bishop Peak is not literally right behind me, I have hiked it recently. About the time the pandemic started, coincidental, I started getting involved in things related to venture capital by joining an angel group known as an Element 8 or E8 Angels. It's a clean tech, climate tech focused club, if you will. Also did some mentoring as part of the, and still do, as part of the Clean Tech Open, and got invited to be part of the selection committee for NREL's Industry Growth Forum, which is a way to say that I've seen a lot of pitches, I've seen a lot of applications to pitch, and also a fair amount of due diligence. So I'll, in my 5 years, but so I'll do my best to represent what's going on with that. But again, my journey is still relatively early compared to some others. I also became a limited partner in Mighty Capital. This is a relatively modest to small sized venture capital firm out of San Francisco. And the reason why maybe that's relevant is they let their limited partners be pretty involved, particularly in the selection committee. And I am probably going to be doing 9 as well, but I've been a AngelCon investor for the last 3 funds as well. So that. Put in some context of what the typical flow or sequence of venture capital raise looks like. Lots of variance, of course, but it tends to go kind of like the following. While you're early on, think you have something, that's going to fly, you go to friends and family, and there it's all about investing in you and a vision. Maybe you've got something working in the garage, or on a lab bench, but it's still pretty darn early. They're really investing in you. And with that money that you perhaps get from friends and family, then and maybe some grants too, by the way, you can maybe get started on at least filing some patent applications and honing out your customer and market fit and making sure that you have a path to competitive advantage. Get your incorporation documents done as well. Where I live and as an angel, and there are also family offices which operate somewhat quasi like a venture capital firm, and then a few venture capital firms that are, again, they're probably a great minority, but are investing in early rounds, will show up in your pre-seed and seed rounds. This is where now getting a lot more regimented about your documentation, about showing especially traction of some kind, which a topic I will come back to. Then the venture capital firms are a lot more voluminous that invest in series A, B, C, D. What happens between those 2 boxes typically is that by the time you get this series A and certainly B, now, and I'm just going to use a software example, now your cost of acquiring a new customer, engagement numbers, satisfaction numbers, and so on are now starting to be consistent, sticky, if you will. And so when venture capital comes in on those series, they're more closer to doing net present value calculations and, underwriting almost, if you will, future growth. It's going to give you this much money. You're going to spend X amount on advertising or whatever it is to acquire new customers. In my software example, that tends to be the focus there. Whereas on the pre-seed and seed rounds, it tends to be heuristics, comparables, rules of thumb, because there's much less known. So I'm going to touch a little bit upon that as I go through here. Now, you might be wondering if your company's, your startup, your business is a fit for venture capital. And one of the things that I can't emphasize enough, it needs to be high growth and feeding into a market where there's ready liquidity. But I mean, that liquidity, I mean, for the investors, as in an acquisition or an IPO. And to attempt to answer why that is, besides that they're just a bunch of greedy people that you wouldn't want to have over at your barbecue, and maybe a few of them fit that description, but really there's actually a very bottoms up explanation for this. Most mathematical bottoms up explanation of this. Most VC funds are structured to have a lifespan of 10 years with maybe an optional extra 1 or 2 years that can be added onto that. This is what limited partners, many of which are, say, pension funds, this is what they're expecting. You know, they want some conclusion to their investment within that time frame. Most of the investing, once a fund gets formed, most of it happens in the first 3 to 4 years. After that, it's usually only follow-ons. So meaning same company you already invested in, maybe do an extra investment at a later round to help continuing what you hope is then a good bet to scale up. The Tech Coast Angels actually took data from 160 investments that had an outcome, some of which weren't good, some of which were very good, and did a Monte Carlo analysis, and here's what they found. Unsurprisingly, 10% of the exits comprise 85 to 90% of a fund's returns. You've heard the 9 out of 10 companies fail, so this is a very close alignment with that. In terms of what the Monte Carlo analysis does is also answer the question, how many investments to start having a decent chance to have a return that pension funds and stuff like that are expecting. So at 25 investments, there's about a 1 in 3 chance to return 5x portfolio wide. And the reason why that number is significant, that at least in 9 years, that equates to a 20% IRR. Now, it turns out, at least historically, the last couple of few years, maybe not so obvious, but your stock bond portfolio blend gets about 8% per year. Commercial real estate, 10 to 12%. The expectations are the venture capitalists that get LPs that return for the next fund is actually 28% or better. So 20% is about any lower than that and out come the pitchforks from your LPs, right? So 20% gets you, is just good enough, if you will. So now if you walk through the 10% of the exits comprise most of the returns, 25 investments, we're not going to have 2.5 succeeding, so I pick 3. That means an exit for those 3 needs to average better than 15x of the money in, right? So that's why, just rocking through the bottoms up math, why they need businesses to grow fast, because there's a limited amount of time, and why, again, a lot of them aren't going to succeed, but why the ones that do really knock it out of the park. And it's all because of this, if you will, overall constraint. Now, there are some venture capital funds, not very many, that do, say, for example, the ones investing in nuclear energy. They have longer time horizons, and they get money from LPs that understand that, right? But those are few and far between. Now, so those early stage investors, again, I kind of mentioned that in the Series A and later, you can have something more of an exercise going through, taking good metrics and profitability and new money in, getting used to do promotion or scale up activities that has a certain return to it. While we're in that pre-seed and seed, heuristics, rules of thumb, and what I'm going to lay out here is the key things that early stage investors are looking for. All right, so first, that high growth, relatively quickly time frame. So that's the part of the first check mark here. But also prefer, not exclusively, but prefer a really good pain and painkiller scenario as compared to vitamins. Let me elaborate on that analogy a little bit. If you have a software business where the customer goes, oh, yeah, that's really interesting. Maybe I'll get 10% efficiency gain. I'm interested in it. We'll take a look at it on our next budget cycle. Yeah, that's probably a vitamin. Vitamins are good business. It's, in fact, going with my analogy, they're about 40% the market size of pain and painkillers, specifically the legal ones anyway. The painkiller scenario is they need it right away, yesterday, fast as you can make it. They want to rip it out of cans if it delivers. That's, of course, where the big if is. That tends to be more tolerant to mistakes, but it also might be where there's a lot of competition as well. So, because everybody's kind of chasing those painkiller scenarios. As an illustrative example, in AngelCon Fund 7, our largest investment is still trying to make the following scenario work, where they could detect batteries before they get actually dumped into back of a truck that comes and picks up your recycling or trash. And the reason being is that in some places, and we actually talked to one that's in Oregon, they were experiencing battery fires almost daily. So huge painkiller situation, big pain in their case. If something could solve this problem and keep the batteries from even getting on the trucks in the first place, they'll buy it immediately. So that's again a preference. Now, if you got a vitamin business, again, it's good business. It just is when it comes to sit down and carve up the money from a fund, they'll tend to try to hunt for the painkiller scenario. Second bullet here is, or check mark, is the team. So ideally, doesn't happen often enough, of course, repeat entrepreneurs. They've done it before. They've had to pivot. They've had to, navigate, situations where maybe the company was going to go under, but managed to pull it off. Those are, again, not often enough, but those are the kind of things that are descriptive of the highly sought after teams. I did list something in here, and I got a QR code later, so don't write down the URL, but there's actually even a Science Direct, if I remember correctly, report where somebody went and interviewed 800 some odd venture capitalists, and unsurprisingly, 96% of them said, and 92 for the failures, but said either the success or failure had almost everything to do with the team. So now you might be wondering, but David, I'm a first-time entrepreneur. How's this going to work out for me? And let me just say that it's never too early to start looking for the right advisors. And by that, I mean actively involved advisors, both whether, great if you can find them in one person, but both somebody with maybe industry connections that you're trying to sell into, and or have done have started multiple startups. And again, if that could be one person, great. At least two. Never too early to add those to the team. As investors, we look at that. It isn't only necessarily just the entrepreneur or entrepreneurs, but also the team behind them in the form of advisors. And then finally, some form of traction. So at pre-seed, like a minimum viable product that's at least maybe gotten to some alpha sites and had the tires kicked, if you will. Come seed, start to maybe look for third-party validation beyond what I just described there. So that can be in the form of, like, let's say you've got a product that is a piece of hardware that perhaps an external testing facility has tested it and said, yes, it performs equal to or better than they're claiming. But even better, of course, if there's some paying customers, which is the best form of traction. So early stage investors, these are the big three. All right, now I want to talk a little bit about approaching them and how that flow typically looks like. And again, depending on the size, because there are some really big ones that I might add a 0 to each of these numbers, but I think this covers quite a few typical sized funds. And that is, and they're trying to squeeze it all into the first 3 or 4 years, so the pace is really crazy fast. First, you'll probably have some sort of screening committee. You'll have 8 to 10 minutes, And the goal there is to give just enough information that they want to bring you back, if you will, for a second date. Sometimes even just to get the first date, you have to send ahead some information, like maybe a really short version of your deck, executive summary, things like that. So there may even be some things you need to send ahead of that. That second date, now I'm going to talk about what needs to be in that presentation on my next slide here. But here's where then probably the general partners or a larger investment committee is the audience you'll have. And of course, they're trying to get to due diligence. I point that out is because there's sometimes a temptation that maybe you have to get all the answers on your slides. Well, they'd probably be too busy. And you probably wouldn't have a tough time getting through all of them. You don't necessarily have them on the top of your head when during the Q&A, but you don't necessarily have to squeeze everything onto the slides. Just keeping in mind, trying to get to the next stage. So on that second meeting deck, this is not necessarily an outline for a set of slides, although you wouldn't be all bad if you did use this, but there is a gazillion opinions about what the perfect set of slides for pitching venture capitalist is. I'm not going to try to repeat all those, and they're all somewhat all over the map. Be careful only of the ones that where somebody said they got financing, got venture capital with these 8 slides. Well, be careful because they're probably a repeat entrepreneur, and that had more to do with why they got their it is much anyway, why they ended up getting an investment than necessarily that they used those particular 8 slides. But I digress. These are the key things that you'll want to be sure to go over. Again, that discussion about the painkillers versus vitamins, you want to lay out what the problem is and your solution and why it's going to succeed, why it's going to succeed quickly and grow fast. Again, back to those overall comments I made about what venture capitalists are looking for given their time constraints. Team and advisors, so that's back to my point earlier that both the actual founders and anybody you've already added to the team that are on the operating side, and advisors that fill in, if need be, any gaps in the team that's actually employees. Then tractions. And then traction, and then I want to bring up a particularly important topic, and that's the milestones. So one of the things that when you get to this second meeting, you want to communicate clearly is you're raising X amount. This is how you're going to use X amount. And after you finish spending that X amount, and maybe a little less because you want some buffer, but after you spend most of that X amount, you're going to achieve a particular milestone or two that will result in future investors wanting to invest in you at a higher valuation. And that's a pretty key thing because I've seen some come through and say, well, I'm going to move the needle forward a little bit, but there's no significant milestone necessarily tied with the investment. And it's like that's a red flag, because what we need to have happen is that there's future investors that want to buy in at a higher valuation. So you need to move the needle in a way that gets to a milestone that significantly lowers risk when you're right down to it, either about the product, the technology, the market fit. Some of those things need to hit a new significant milestone. So that and your use of funds are important things to tie together. And of course, there needs to be some discussion about your competitors. Another thing, if you don't talk about competition, it's a red flag. Even if it's just the old way of doing things, that's still competition. But you probably have some that loosely fall into your space, even beyond that. And the moat being the clever term for durable competitive advantage, whatever that you're doing to ultimately enable that. Sometimes that's patents, sometimes not at all. Maybe out executing, it may be a network effect. There are a number of ways to achieve things that fall into a, again, competitive advantage in the longer view. In the use of funds in a financial snapshot, Another thing I can't emphasize enough is that if you get to due diligence, you want to have a 3 to 5 year projection handy. If it's a hardware product, definitely 5 years. Software probably okay with 3. And you should have both a baseline and a pessimistic projection. And the key part to having a pessimistic, if you will, projection is to then be able to say, I'm raising enough to survive even if it doesn't go as well as I think it should, right? So the other thing that is a big tripping point is it's no good to give an investment in a startup that didn't spend or plan around a pessimistic scenario. And even though they may have been on to something really great, they couldn't make it to the next round of financing, and perhaps capital's kind of freezing up or something like that, and it's harder to get the next round, and you end up with a closing scenario. So you don't want that, of course. That actually means in some cases raising a little bit more than you absolutely need. All right, then there's the mechanics of deal terms, and then an important thing of deal terms is like what instrument you're offering investors and what the capitalization is or what the discount rate. I'm not going to spend time going over those details, but just have some clarity about those deal terms. If there's a minimum check size, particularly for individual investors, that's where you would communicate it. Then this might be controversial depending on how you look at it. Discuss what your exit opportunities are. Not an exit plan. If you have one, great, but unlikely. You know, I'm going to use the word plan because it sounds like something, you know, more likely guaranteed. It most likely won't be. But earlier I mentioned liquidity. Well, unless you're talking to a venture capitalist or an individual that's really knowledgeable about the space you're going in, it's best to go ahead and discuss comparables, not unlike real estate, where you say, here's companies kind of sort of similar to mine that have gotten funding. Here's companies kind of sort of similar to mine that have been acquired or went IPO, and go ahead and lay those out. Again, for most investors, that's a useful thing. They're going to try to go double check your work and see if there's any others, of course. But good to lay those out there. Yeah, when you get right down to it, it is playing to the greed part a little bit. Here's an extra credit one that I can't emphasize enough as being a really good thing to do. It's time consuming, however, and that is to learn what that venture capital firm or individual investor, what they're interested in investing in. So I listed here as fit. So that could be, you know, they're interested in food tech, and you have a food tech startup, so there's a fit. A lot of venture capitalist firms will actually purposely build a network of operators, say, or some of them, particularly if they're investing in hardware, might have actual labs that you can set up and test your equipment in. And if that's something you need and something they have, that's sometimes virtuous smart money. That's good for both sides. So in other words, even the investors like, oh, good, you know, because too often they invest in something and then hardly ever hear from the startup again. That's actually not the preferred scenario. Both want to hear from them, but also interested in helping them succeed. Because back to that, you know, only 10% of the startups end up being successful exits. Well, they'd like to increase their odds by finding stuff where they can directly help. Also fit, being not unlike myself, being in the Element 8 Angels, is we invest in companies that are in the clean tech or climate tech space. So that might mean putting a little extra effort into calculating what difference you'd make to the carbon footprint, for example. And then finally, and this one's a little trickier, if they have, because I've seen a couple successfully do this, if they have a portfolio company that you'd like to partner with. All right, so again, many times they have them on their website, then they would look at that as a positive thing, potentially. If they've invested in something that's really a lot like your company, then that's not something you might not want to bother approaching, because they shouldn't anyway. If you will, that's a legal exposure to them if they are potentially either board observing or on the board of companies that are competing. That's actually a bad thing for them. So, but somebody else in their portfolio companies that maybe somebody would be an interesting partner, and if you merge with them later, nothing wrong with that. So those are kind of things that if, again, it's time consuming, I'll admit, if you can look ahead at what kind of things that are the venture capital firm that you're going to approach, what kind of things they're looking for, what kind of things they may be able to bring to you, and that include, the things I mentioned, anywhere from lab to connections to operators that can step in and help you, and other portfolio companies they have. All right. To wrap up, I thought you might have the question, or somebody might have the question is, well, where do you find these people? Where do you find these venture capitalists? And I think I've just learned of where one might be trying to do something along the lines of Match.com for the equivalent, of Match.com for I'm probably dating myself. I don't know. Yeah, I'm married, so I don't know what the current dating apps are, but trying to find either venture capitalists or individuals that fit. Pitch competitions, not unlike the Angel Con. There is a website, Signal NFX, that is free to use, that has a reasonable amount of, particularly on the individuals front, and some high level information about what they're investing in, which may or may not be current. So just a caveat there. There are two sources that actually would be also useful in figuring out your comparables, and that being, other deal flow or other acquisitions or IPOs. One's kind of pricey, that's PitchBook, but Crunchbase Pro, you can at least do a 2-week free trial, which you can't do with PitchBook. And even if you paid for it, I think it's $500 or $600 a year. So it's comparatively to PitchBook reasonable. Participating in accelerators, because is another useful way to end up in front of investors, and because they usually have a network of investors either they've cultivated very overtly or just tend to hang around. And anywhere from Y Combinator, Techstars, some of the big ones here I've listed, Founders Inc., Plug and Play Tech, and then of course universities, not unlike the Cal Poly's Center of Innovation and Entrepreneurship, and the Angel Con that I mentioned, event or fund and set of events. There are some sector specific ones. There's the Clean Tech Open, which I mentioned, SOSV, and then a lot of corporates will also run their own accelerators as well. So obviously, that would be something you'd need to be a fit for, something that they're, maybe even could be an eventual acquirer. So if that makes sense, those are out there. Of course, angel groups, not unlike the Tech Coast Angels and the Element 8 Angels. And then I'll just say that historically, unless you're a B2C or consumer products focused startup, I don't recommend going to the AngelList, WeFunder, et cetera. The crowdsourcing tends that I've heard anyway. The venture capitalists kind of turn their nose up at those. Maybe that's changing. Man, it probably isn't entirely fair. But unless, of course, you fall into the B2C or CPG folks. I know there's some startups that have gone and only fundraised from those. And, they were probably capital light and got to some successful exit or scenario for those. So they do exist. But however, note, venture capitalists tend to kind of turn their nose up at them.